Well, hello and welcome. My name is Drew McMillan, and I'm a partner at Sage Spring Wealth Partners. We are a full-service, comprehensive wealth management and investment management firm headquartered in Nashville, Tennessee, with office locations across the country and clients nationwide. Our mission is to provide financial clarity and confidence to the individuals and families we serve through our wealth management, investment management, financial planning, tax, and estate planning services. We also help business owners with their valuation, estate and tax planning, and succession planning needs, as well as their financial planning, wealth management needs after a successful exit event. We host a series of educational webinars throughout the year with subject matter experts, and today's topic is going to be on estate planning, so thank you for joining us. Before we dive in, I want to cover a few housekeeping notes. We want this webinar to be as interactive as possible. So first of all, you should see a chat feature on the right side of your screen. If you wouldn't mind, please go ahead and let us know where you're joining from today. If you don't see the chat option, please click the white message circle on the bottom right of your screen. There will also be a set aside a time at the end of the presentation to go through questions and answers. I just want to encourage you to submit a question as soon as you have one during the presentation. Hopefully, most questions will be answered through the material we cover, but we will get through as many as possible during the Q&A time. All questions are completely anonymous, and so there's no silly question at all. We want to encourage you to submit as many as you'd like. Again, you can click the engage circle at the bottom right to do this, and you should see an option to submit a question. Finally, there's going to be a few polling questions throughout the presentation to further engage. So I want to encourage you to participate when those polls go live. So why estate planning? We've noticed that there's a few myths when it comes to estate planning. First of all, many people believe estate planning is only for the high net worth. While the high net worth and business owners, they do have unique challenges when it comes to effectively passing assets responsibly and tax efficiently. The reality is that if you are tuned in and are 18 years or older, you need an estate plan. Without one, you potentially run the risk that the state in which you reside determines who receives your assets, how much they receive, and when they receive them. Additionally, there are some major estate and gift tax laws that are set to change at the end of next year, 2025. And we believe it's important to go ahead and start that conversation now so that you know what is changing and potentially some strategies to consider prior to that time. So here is our agenda today. We are going to talk through the basics of estate planning. We are going to hit on the federal estate and gift tax system. We're going to talk about these changes that I've alluded to that are coming at the end of 2025. We're going to talk specifically about business owners and their unique situation, what they're doing to plan for this. We're going to talk about options for making gifts now or at death. We're also going to talk about how charitable giving and philanthropic desires can play a part of this. And then finally, we will spend some time answering any questions that you have. So our subject matter expert today is John Bunge. John is a private wealth services attorney with Holland & Knight. He's based out of their Nashville, Tennessee office. He helps families and business owners navigate the complexities of estate planning, estate and gift tax strategies, and succession planning for business owners. So thank you for joining us today, John.
Yeah, thanks for having me, Drew.
So I want to start from just a very simplified, high level when it comes to estate planning. I want to talk about the basics of estate planning. So what is an estate plan? But before we do that, I want to go to our first poll today for the audience. Again, if you don't see the poll, click on the white engage circle at the very bottom. But the first question today, hearing from you all, is do you currently have an estate plan in place? So we're curious, out of everybody that's here, how many actually have and feel great about their estate plan that they currently have in place? I'll pause for a moment just to get these answers in. So go ahead and answer that. Click the white engage circle. If you've not done so already, you should see an option to complete the poll or engage in the chat. So far, about 60% that have come in said no to this, that they do not have a current estate plan in or do not feel great about their current estate plans. And that's not surprising, John. That's something that we see pretty often, the work that we do. Very few have an estate plan. No the summary and the important provisions of their estate plan, or feel really great that the estate plan matches what they want to happen. So I want us to start from this high level and just simply ask, what is an estate plan and why is it important?
Definitely, Drew. So I'm going to go through maybe 5 components that you would typically see in an estate plan. What we just kind of refer to as the base documents. It's to make sure that you have designated the person who's supposed to make decisions for you, and you've told them what to do essentially in these different situations. So the will should be pretty familiar. It's the document that applies upon your death, only upon your death. And it says how assets are going to be distributed, whether that's with the trustee or not, who's going to be the executor, who's going to care for your minor children, you appoint a guardian through your will. And if you don't have a will, state law determines how your assets go and who would be making decisions. You're going to have some family member kind of next of kin. There's a priority there. Actually go to court, request to be appointed, and then they'll have to do a much more involved court process than they would typically if you have a will. And also, for example, the state of Tennessee has written your will to say that even if you have 2 minor children and a spouse and you die, that your spouse only gets a third and the 2 minor children each get a third. That's one example. Another one in Alabama, you're married, you don't have any kids, and you have a parent living. Half of your assets would go to your parent and half would go to your spouse. So, just examples of places where the state law says what happens, and you have to write a will in order to change that. And then often we pair a will with a revocable trust. In a lot of cases, the revocable trust is essentially, it's a piece of the will. It functions to distribute the assets that pass through your will. They go to the trust, and the trust says what happens. The advantages of a trust that can be funded during life. You call this a revocable trust or a living trust. It can be funded during life. It doesn't really have any consequences for you because it goes on your tax return still. There's no real big formalities in terms of dealing with a revocable trust while you're living. But the assets that go in there can avoid probate. They can be more easily managed if you become disabled. And importantly for a lot of our clients is that the revocable trust does not become public record typically. A will is public record in the probate court where you resided at your death, but the revocable trust is not, and it keeps things private, and beneficiaries can typically only find out about what specific provisions are made for them. They don't have access to the whole plan and keeps things private.
So with this type of trust, John, I think when some people hear trust, they think, well, I'm restricted in being able to access my assets. This is not that type of trust. Is that right?
Absolutely, Drew. So the revocable trust, living trust, whatever you hear it called, this is a totally separate category from an irrevocable trust. And, the living trust or revocable trust, while it exists during your life, it mostly does not matter during your life unless you become disabled. And it really applies upon your death because the assets in there or coming through your will will go there, and then that trust document will say what happens, who's in charge, who's getting distributions, et cetera. And then in terms of that avoiding probate aspect, I don't try to have clients a lot of the time try to fund every single asset they own into the trust, especially in Tennessee where the probate process is not all that difficult. But specific types of assets like an interest in a business and real estate that's not in the state that you reside in, you can really save some headache and money by having that in the trust where it avoids probate. You don't have to go to another state, and you don't have to wait for probate court in order to act in terms of ownership of a business interest. So those are really the documents that generally only apply upon your death. They say who's in charge and who gets what. And then there are several documents that apply during life that are really integral parts of the estate plan as well. And, definitely want to have both. So the first would be the financial power of attorney. This is sometimes called the general power of attorney, and it's a document that designates the person who would make decisions regarding your financial affairs in general. Basically, any type of decision that's not a healthcare decision that we'll get to on the next slide. So this is basically acting in your stead if you are incapacitated. They can also be effective when you're not incapacitated. You appoint your spouse and they can sign things for you and make decisions if you're not available. But most often it's only upon incapacity, and it's really in general every decision that you could make, they can make, subject to a few limitations. But it's to make sure that you don't have to go to court, or your loved one, your spouse, your child doesn't have to go to court and ask the court to make them appointed as guardian if you become incapacitated. A guardianship or a conservatorship proceeding in court is just a lot more involved. It's expensive, and having the power of attorney in place can generally avoid the need for that.
Okay.
And then on to the healthcare decisions. Again, power of attorney for healthcare, that applies only to healthcare decisions, and it generally applies only when you can't make your own decisions or communicate your own decisions. This is another place where, designating a specific person, that's the spouse, that's this child, for example, it avoids controversy among the family, because a lot of the time you have children and spouse involved, and maybe a blended family. There can be, disagreement about decisions and who's really in charge. And this lets you know exactly who's in charge. And, if you don't have that, there can be delays. There could even be, disputes in court about major decisions regarding healthcare. So again, it's a thing to avoid a costly mess if that situation arises.
John,
And
something
then,
I might add real quick on that one is I think a hole that gets left sometimes is an adult child graduates high school, goes off to college or whatever is next, not quite married yet, so typically doesn't have the state documents done. It seems like that healthcare power of attorney is really important for the parents to have on the adult children. Is that true?
Definitely, Drew. I think that's a good point. A lot of clients would expect that they can still make healthcare decisions and talk to the doctors of their 19-year-old child who went to college. It's generally not the case. Of course, we have federal laws that prevent disclosures, HIPAA. So the healthcare power of attorney could give the parent the power to, at the very least, access medical records and speak to providers, which they could have done before while the child was a minor, and now they're adult and they need some kind of document to say that their parents can do that. So that's definitely a good point, Drew.
Okay.
And then the last piece, which it's generally optional, but the living will, or sometimes called an advance directive, this is a document that specifies in specific situations what you want to happen. So these can be kind of complicated with a lot of different situations and a lot of different types of treatment. I tend to go with a more simple type of form that is just about, if you're in a terminal condition with no likelihood of recovering from that condition, and the doctors all agree on that, whether you want basically artificial support to continue or not. And that's an example of the core decision. There's more specifics and more details on a lot of those forms, but in general, it's to tell, one, the healthcare provider, and two, your agent or your family members what you want to happen, so that it doesn't become a difficult decision for them or a controversial decision. So
even though this one's optional, we encourage it because it really does take a lot of the weight of the world on the shoulders of the healthcare agent that's named in your power of attorney if he or she is forced with making that decision about removing life support. You have completed this when you are of sound mind to say, this is what I would have wanted, and it just takes a lot of stress off of that agent.
Absolutely. Yeah.
So those would be the major basic estate planning documents that pretty much everybody should have. Will, potentially a trust, powers of attorney for finances, for healthcare, and then this living will or advance directive. So let's transition a little bit and talk about the complexities of federal estate and gift tax. I think there maybe are some people that are unaware that potentially they could be and they could owe taxes at their passing. So talk us through high level what this is. Let's define it a little bit and then go from there.
Definitely. So, just to put it simply, there's a federal tax that applies to the value of your assets transferred, whether during life or at death. And we're talking about a federal tax, and there are state level taxes that vary a little bit here. Tennessee doesn't have one. I'm not going to try to get into the details of those, but definitely be aware whether your state has one as well. But it's a tax on the transfer of your assets to beneficiaries. Important thing to remember here is that there is an unlimited marital deduction. So passing assets to your spouse, as long as it's done in the right way, is not going to be taxable typically, but we're talking really about passing assets to your children after the second death, or even while you're living. And you get into the numbers here because there's a lot of misconceptions about this. But the annual exclusion amount is, a lot of people hear about this. It used to be $10,000. It's been indexed for inflation for a while now, and now it's $18,000, and that's the amount that one individual can give away to one other individual without having to use any amount of the estate and gift tax exemption, which we'll discuss in just a second. So the $18,000 is the amount that you can do without filing a gift tax return. If it's two spouses to one person, they can each give $18,000. Giving to your child and their spouse, $18,000 for each. It's per person and per donee that $18,000 apply. So a lot of people have the misconception that, this $18,000, that's kind of it. Like if I go above this in a year, I'm going to have to pay gift tax. But the other piece of this is the lifetime exemption. And that is $13.61 million per person, per donor, currently. And that means that basically, if I have $13 million and I'm going to give it to my children at my death, right now, that can pass without incurring an estate tax. It's only the amount that goes above that exemption that is subject to the 40% federal estate or gift tax. Gift taxes for lifetime transfers, estate taxes for transfers at death. But this exemption number is what we call it's derived from what's called the unified credit, which is a credit that applies both against gift tax and estate tax. So if you use some for gifting purposes, you don't have that for estate tax purposes. And this is what we'll talk about in a little bit about the sunset of this. And just so you know, that in 2017, it was a $5 million index for inflation at that time, and then it doubled to $10 million index for inflation. So that $13.61 million is this year's exemption as index for inflation.
So just to confirm, because it is a misconception we hear a lot, the $18,000, the annual gift amount, you can gift it; it's completely tax free. If you gift over that amount, then it doesn't mean that it's taxable. It just means that this 13.61 bank of money, if you will, that you can gift either during life or at your death, totally tax-free to somebody other than a spouse. It just means that it is it's a debit against that amount. You just have to file a gift tax return, letting the government know that you gave some money beyond the annual exclusion amount, but it doesn't mean that it was taxable. So to John's point, there's some changes that are coming that are going to impact this 13.61 million, as well as some other tax provisions as well. And they're set to sunset at the end of next year if Congress doesn't make any changes to that. So talk us through that, John.
Definitely. So yeah, again, a lot of these tax breaks came from the 2017 Tax Act that was passed under the Trump administration when Republicans controlled Congress as well. But still, to get this passed, and as it happens with a lot of these types of laws, they had to have a sunset in there to make it pass muster in terms of the procedure in Congress. So that sunset for a lot of these individual tax breaks happens at the end of 2025. And it's not just income tax, it's also the estate and gift tax aspect. So wanted to mention the income tax aspect because that's also top of mind for a lot of people. And you go so the tax brackets, the top bracket being 39.6% was cut down to 37, but all the brackets were really cut down quite a bit under that act. So at the end of 2025, if the law is not changed, all those brackets go all the way back up to where they were in 2016. And that's going to be a huge increase in the effective tax rate for a lot of people. If somebody's at the 39.6 and they make millions and millions of dollars, it's only a 2.6% increase effectively. But for a lot of people that are within those brackets or close to the top but not there, the tax amount is going to be a lot higher. And then the other huge thing is that the qualified business income deduction, which is a 20% reduction essentially in the tax that applies to a pass-through business that somebody owns. So they own sole proprietorship that they operate themselves, they own an interest in a partnership or an LLC, or they own an interest in an S corporation. All those types of businesses were basically getting this 20% tax break under the new law, in addition to the lower brackets. And that was mostly passed to kind of keep parity with C corporations, because C corporations under the new law are taxed at 21% flat across the board, and no brackets there. And importantly, the C corporation rate is permanent, ostensibly permanent. Of course, they can change the law, but it's not subject to sunset, but the pass-through rates are. So effectively, if you're a 37% bracket, knock 20% off of it for this pass-through business deduction, 29.6% federal rate on that pass-through business. That's going out all the way up by 10% to 39.6 in the top bracket. So definitely a big deal on the income tax aspect. But here we're
for our business owners that are listening today, over the next 12, 18 months would be an ideal time to revisit with your tax preparer or attorney your corporate structure to be sure that it is the most efficient setup for you. There's a lot to that, more than we can cover in this webinar, but a great time to revisit your structure.
Definitely. And then so the other huge aspect of this sunset is that at the end of 2025, that $13.61 million exemption, it will be indexed to inflation for 2025. So maybe it'll be 14 million or so at that time. But at the end of 2025, it's going to be cut in half. It'll be $5 million indexed for inflation instead of $10 million indexed for inflation. So we would expect, if they don't change the law as of January 1st, 2026, the exemption available, we've got $7 million per person instead of the 13 or essentially 14 million. I wanted to emphasize there, this is a per person thing. It's not per donee. $13.6 million. It's what I can give to any of my children, any of my friends, any other family members, but that's individual to each spouse in general. So between two spouses, essentially $28 million can be given away free of gift tax next year, but that number's cut in half in 2026. Right. So really a big deal.
And so for some people, this is a very big deal in that just rough math, the husband and wife could pass away collectively about $26 million of net worth today, or of total assets. And this is where the title of our presentation comes in, that 40% tax rate essentially on essentially every dollar after that amount. And if that is set to be cut in half, now you're looking at potentially a $13 to $14 million total value between husband and wife. And this includes real estate values that have gone up tremendously the past few years. a lot of wealth and private businesses in this country, and investment values, financial assets that have gone up quite a bit as well. So there are a lot of people that are going to find themselves in a taxable estate situation in 2026. So in preparation of this, let's talk about options that we can do if you find yourself in this situation. What are some options that we can do to plan for this?
Yeah, so the issue with this, the increased amount and then it sunsets and it goes down, is that there are rules that have been issued by the IRS that say that if you used $14 million this year and then it gets cut down to $7 million next year, they don't recapture that amount. Just because the exemptions went down doesn't mean that you're going to end up ultimately paying tax on that extra $7 million that you gave away. So that's positive, but the issue is that it's only the amount that went above the current or the reverted, the half number. So for example, if I gave away $7 million today out of my $14 million of exemption, I haven't used any of that extra. And when it goes down by half in 2026, that extra just disappears. So I've used 7, and as of 2026, I have 0 because I've used 7. The only way to effectively lock in these extra exemptions is to use it during life before the sunset in 2026. So that's a place where, giving away $14 million by one spouse or $28 million by two spouses, those are huge amounts. And, for a lot of clients that are in kind of this range where, they don't have hundreds of millions of dollars, they're not ready to part with that level of assets, give it to their kids, et cetera. That's where a lot of people's heads go. I don't want to give this away. I need it. I want to live my lifestyle. I want to have my big cushion of having a lot of money in my retirement, et cetera. I can't give away $28 million collectively with my spouse. So this is where, one option that we just see used a lot is what's colloquially called spousal lifetime access trust, or SLAT. But all that really means is that it's a trust is an irrevocable trust, totally different than the revocable or living trust we already talked about. So it's irrevocable. One spouse sets it up, and then the other spouse is permitted to be a beneficiary of that, along with the children or grandchildren, if that's what you want. But it's designed to be one irrevocable, a completed gift that uses that exemption, and outside of both spouses' taxable estates for estate tax purposes. There are circumstances you create a trust and it comes back into your estate, but these are designed to be outside of the estate and use the gifting exemption. So if I gave $14 million to one of these trusts now to lock in that extra exemption, then it goes down in 2026, I've locked in that number. I still have 0 in 2026, but I've effectively gotten the 14 out of my estate, where I won't have that opportunity going forward.
And you've gotten all the future growth out of your estate, right, as well. I mean, I'm thinking
Absolutely.
about a business owner who's, maybe it's a lower value today, it's going to grow. They can go ahead and gift that out and not only use that up, but all future growth is out of the estate, not taxable when they pass as well. That's fair?
That's right. And that's another great reason to make current gifts as opposed to waiting till death.
Okay.
Another thing I'd mention is a lot of business owners, they have their business and its balance sheet only shows, $1 million in net worth on that business's balance sheet because it's fairly asset light type business, but they're making $1, $2, $3 million a year off that business. You might think, well, I'm only giving away $1 million of assets at my death, so it shouldn't be subject to that estate tax. I'm well under that. But the IRS looks at the actual fair market value of that business as a going concern. So that's a whole different thing. And that's generally, there's goodwill basically built into that business that allows you to make $3 million a year off of $1 million of assets. That business might be worth 10, 15, $20 million in your estate, even if its balance sheet doesn't show that much net worth. So
Okay.
Really important to think about that as well.
Yeah. And so the uniqueness of this spousal lifetime access trust is that you are technically giving the assets out of your estate, but because your spouse is a beneficiary, it's not necessarily assets that both of you are parting with and you can never use or live on. As long as both spouses are living, there's access to it for the marital unit.
Yeah, effectively, we call this just indirect access.
Yeah.
And there's also flexibility where that spouse can actually be the trustee as long as it's designed in the right way, so you don't actually lose control outside the marital unit. And then that spouse can also potentially have the ability in their will to designate where it goes. The donor can't do that, but the spouse who receives the gift can. And so that leaves flexibility for, well, we don't want to make it equal to children. We want to mix it up somehow or give some to charity because it's too much or something like that. So there's a lot of flexibility that can be built into that trust, even though it's considered irrevocable and outside of the taxable estate.
Okay.
And another thing I mentioned is that there's, 14 million for one spouse. There is the potential for the other spouse to do the same thing. But that's where we run into this issue of reciprocal trusts, and we need to make those so it doesn't look to the IRS like it was basically, I do this for you, you do this for me. The IRS can look through that and say, well, you didn't really do anything. So a lot of very specific details to get into there. We don't need to harp on that. But again, there's potential for two spouses to do that for each other as well, as long as it's designed right.
Okay.
And then the other side of this gifting is that, well, maybe you do have enough that you can comfortably give away a big chunk, $14 million. Maybe that's the closely held business, non-voting interest in it or something like that, or it's just other assets. But your children are young and they don't have any wherewithal. They don't know how much money the family has. They don't have the wherewithal to deal with it, to manage it. You don't want them to access it. You want them to get their own jobs, get their own education, and start, their own personal journey without having millions of dollars in inheritance for them. So this is where by using a trust, even if this is not a SLAT, and it could be a SLAT, but what we call a silent trust, which is basically a trust where the agreement provides that there's no reporting to the children. They don't have to be notified of the existence of the trust while they're living. You can specify a specific time that would happen, even if that was after the first or the second death. But it's an ability to create a trust, make a large gift, lock in that exemption without actually giving children any control or even knowledge of what that inheritance is. So it's a way that makes it more palatable, basically, to make those major gifts when you don't feel like you're really ready to.
Okay. Well, and I want to pivot and talk about charitable planning, because as the tax code and estate tax code exists today, there are, for those that have philanthropic desires either now or at their passing, there's some major tax leverage that can happen within effective charitable planning with their estate planning. But before we do that, I want to hit a next poll question real quick. So again, go to the engage section of this webinar. Click the white circle at the bottom. If you need to pull that back up and click the, you want to answer the poll question. But question number 2 is just that if you feel as though any charitable plans, if you are charitably inclined, have been factored in to your current estate plan. So go ahead and answer that if you don't mind, and we'll go on talking about some charitable strategies and the benefits of them.
Okay. So here, Drew, I'd start by saying that for gift and estate tax purposes, there's also an unlimited charitable deduction. So we can tell clients that the estate tax is entirely voluntary. If you gave everything to charity at the second death, you can give everything to the spouse at the first death in one way or another and not pay estate tax, and everything went to charity at the second death, or everything in excess of that $14 million or whatever we have, you don't pay estate taxes. The charity gets it. There are obviously a lot of other ways to reduce taxes that we talked about, to reduce those estate taxes, reduce what the taxable estate's going to be. But ultimately, at the end of the day, it can also go to charity. And there's ways to leverage charity that we'll get to in a second. But really, the most straightforward way to benefit charity, during life and even at death, is through a donor advised fund. So that is, most are familiar with that at this point, but essentially it's a charitable checking account that, the donor gives it to a charity. Typically, this is a large public charity or a community foundation that creates this separate account with the gift that's made. And the proceeds of that gift, the donor can advise the charity on which charities to send those assets to. And it doesn't have to happen all at once. There's no requirement right now that a certain percentage gets paid out each year. It can accumulate for, essentially indefinitely under current laws. There's some push to change that, but right now that donor advised fund is very flexible. As a technical matter, the donor doesn't actually control that account. They only have the advisory privileges, which they can pass to their spouse or include their spouse in. They can include their children in. There's succession provisions that most of those sponsors of donor advised funds provide. And it's a really tax efficient way to give away assets during life, because that's considered a public charity, which means that any appreciated capital gain type assets that would otherwise produce long-term capital gain. So that includes typical stock account, the appreciated stocks. It includes real estate. It includes closely held businesses, even in certain circumstances that can work. And you get to a deduction equal to the actual fair market value of that property, not reduced by the capital gain that you essentially avoided by funding that DAF. So you get that big income tax deduction. You don't pay the capital gains tax on that asset ultimately. So more to charity, bigger benefit to you, and less to the IRS.
Yeah, the donor advised fund is such a flexible tool that's used often, like you said, pre-transaction planning with business owners going through a sale. Could just be capital gains tax and income tax planning with appreciated marketable investments like stocks with the market being high. And then the ability for the donor to control when these end charities receive the money, how much they receive, who receives them. Very flexible tool, but also can be leveraged when somebody passes as well. A strategy often considered is if you have pre-tax assets like a 401k, an IRA, something like that, and you have enough assets that the surviving spouse or your beneficiaries would be okay inheriting the other assets, you can change the beneficiary of your pre-tax retirement account to the donor advised fund. And so not only could it save you in terms of estate tax planning because your estate is lower, but also income tax planning for future generations, because if left to children, to individuals, they will pay taxes on that money as they take it out. Whereas if you leave it to a donor advised fund, being a tax-free entity, it's 100% tax-free. And then you can name your spouse or the children, whoever you'd like, as the successor advisors on that donor advised fund. So it creates a really neat legacy giving bucket as well. So a really useful tool.
Yeah, that's a great point, Drew. And designating an IRA to have that as the beneficiary, if you're subject to estate tax, the estate tax applies to the full fair market value of that account, not reduced for the built-in tax. So 40% estate tax, and then as the beneficiaries take it out, up to 40% income tax. So really do the math, 36 cents on the dollar to your children versus the charity getting 100% and not paying estate tax or income tax on it. So definitely a great strategy there. So then a couple of variations to charitable planning. Drew mentioned the transfer of an asset before a liquidity event. Somebody selling their closely held business. If they make a pre-transaction donation to a donor advised fund, for example, that you have the effect of avoiding the tax on that. You get the deduction that can be used in that year, which is a very high income year, so it's a valuable deduction. And that's a great strategy. A variation on that is to use what's called a charitable remainder trust. A charitable remainder trust is the trust itself is a tax-exempt entity. It pays a series of annuity payments, or what's called unit trust payments, but to skip the details, a predictable series of payments to the donor and or their spouse. And at their death, typically, it would go to the designated charity, which could be the donor advised fund, and often is. And this lets you, that charitable remainder trust can sell that taxable gain asset without paying any capital gains tax, and it can reinvest it on a gross basis without paying the tax. And then the donor only pays the tax on that sale essentially as they receive payments. Those payments come out, it's called worst first. If there was ordinary income in that trust, it would come out first, but then the capital gain comes out. And it's only as payments are made. And these can be structured to actually effectively defer payments for a long period of time as well. So basically, it's taking advantage of that tax-exempt status of the charitable remainder trust and the charitable remainder beneficiary to get just a much better after-tax result for the donor and for the charity. And these can be structured in a lot of different ways. And another thing I'd mention on this one is if somebody's giving asset, they want their spouse to have the benefit of the assets during the spouse's life. They don't want to give to charity yet, but they know they want this certain bucket to go to charity and not to the children, or maybe there's no children to benefit and you just want the spouse to get it. You can do this as a testamentary at death, where the spouse gets that annuity payment during their life and the remainder goes to charity, and there's no estate tax on that, and because it's the spouse and the charity, which are both deductible, but the spouse gets that advantage of the tax-free growth kind of in the interim.
Yeah. So this is a great strategy, not only from we need some income maybe, but an income tax play, potentially selling an asset, to a charitable deduction strategy, because we are receiving some type of upfront deduction based on the end value, and then of course the charities get to benefit and use those funds when they ultimately go to them. So within the charitable structure world, depending on your goals, your needs, your assets, your balance sheet, your beneficiaries, there are a lot of different structures and even more that we didn't have time to get to in this, but just wanted to highlight a couple larger ones. So I want to talk about business owners that are tuned in today. We've kind of sprinkled in a little bit of business owner talk through this presentation, but business owners have a unique balance sheet in that, a lot of their closely held, privately held businesses, they're not exactly sure maybe what they're worth. It could be worth a lot. They could maybe think they're not worth a lot, but they really are. And so they're kind of unique assets, and they also maybe get some favorable valuations and things like that currently through the eyes of the IRS. So just talk to me about the work you're doing with business owners right now.
Yeah, Drew. So, a lot of our clients, the family business is a huge part of the estate. It's, can be 90+% in a lot of cases. But, the business has value, and it's, if it becomes part of the taxable estate and it's in there at the actual value and it's not discounted for any reason, that's a large amount that has to be paid to the IRS without having much liquidity. So there are ways to defer that tax that's owed on that asset at death. But in general, you have a big liquidity problem. You have to pay the estate tax somehow out of the cash flow from the business or borrowing or both. So giving away a good part of the business during life is a great strategy for a business owner that wants to keep the business going and not have estate taxes interrupt the business and transition it to the next generation. So as you mentioned, Drew, there's valuation advantages to a closely held business that don't apply to some other assets. And one of those is that clients that, are out in the market looking at bids from private equity firms, for example, they might be looking at 8 times multiples, 10 times multiples of earnings, even higher in those situations. But if you don't have that kind of transaction on the horizon, a business appraiser is typically going to apply a much lower multiple because it's a, it's not a bidding war, and it's not a strategic asset for a given buyer and seller. So it's just based on the cash flows. So typically that gives a much lower enterprise value to that business by making a current transfer of it before a liquidity event, for example. And then you can also give away minority or non-voting interest in the business, which is an additional discount of, typically combined 30 to 40% discount from that lower enterprise value to start with. So it's a great strategy to get that type of assets out of the estate, use the exemption, and then it's not going to be part of the taxable estate that's going to create the estate tax owed and liquidity crunch. It might reduce the need for life insurance if you're using life insurance to fund that eventuality. So, right now we have a good opportunity to do that because the exemptions are so high, and it's you get the twofer of locking in the higher exemption and locking in a lower value for the business, and that's a big advantage. And then another thing to mention there is that in a lot of cases, even if the business was worth more than can be given away, more than the $14 million, you can transfer more and freeze that valuation and keep it out of the taxable estate using leverage. Essentially, if the trust, you make a gift to the trust and it pays you for the additional part that's not a gift in the form of a note, is the most simple example. And then that note is amortized out of the cash flow from the business. And then so ultimately, nothing in the taxable estate, it's getting spent, it's being paid to income taxes, and the trust will pay that note off, and it has the whole business, and it's not subject to estate tax. So specifically, private business owners have a lot of opportunity there to make transfers and take advantage of those things.
Yeah, just to reiterate, if you or know somebody or spouse of someone who has a privately held business, even if the net income or profits maybe aren't exorbitantly high, the multiples that we have seen the past few years, that valuation could be a lot higher than you think. And there are some strategic strategies and discounting that should be considered prior to the end of next year, at least a discussion about it to know the pros and cons. So highly encourage, if you are a small business owner, to revisit your estate plan, along with what I said earlier. We said earlier about revisiting your structure from an income tax perspective as well. So let's transition on here. I want to reserve some time to go through some questions. There's been some questions submitted, so I want to be sure to ask these. But real quick, before we do, just a quick poll. After hearing this and going through this, how many of you would say now that updating your estate plan is something that needs to happen? You feel like sometime here in the next 6 to 12 months, making adjustments. So please engage with that. I'll wait for just a second to see these responses kind of roll in, and then we'll move to Q&A here in just a minute. Okay, so far about 70% have said yes, that they do feel like they need to make some changes to their estate plan. So we'd encourage you to do so. The good news, like I said earlier, is you can do something about this. We can make changes, whether it's provisions you want differently in your plan, charitable strategies you want factored in, planning for closely held businesses, the estate taxes, all of that. Now is the time to do that. So I want to move into a time of Q&A. So we've had some questions submitted, and again, click the engage button at the top right of your screen, submit your questions. We'll get through as many as we can here in the final few minutes. But let me start with this one, John. So we've talked about these changes happening at the end of next year, but there's also an election this year. So the question is, how can the election impact what's going to happen at the end of next year? And what are you all advising people do on it now, kind of in this limbo where we don't exactly know who's going to be in control and make decisions?
It's a great question, and we all wish we had a crystal ball on that stuff. I want to emphasize that the sunset happens if Congress doesn't do anything. They have to change the law one way or another to prevent it from happening. So, I don't know what the odds makers are giving on the election, but I think a good chunk of those odds would indicate some kind of split form of government where one party has the House or Senate or both, and another party has the White House, which sets up a scenario where, they'd have to agree on something. And, definitely the estate tax is a hot potato type of issue that, maybe that's a giveaway in exchange for something else in terms of the income tax when there's a negotiation, or, it's very hard to predict, obviously. Or if you just expect gridlock in that they can't come to an agreement on extending these tax cuts or dealing with our tax revenue issues, it's kind of betting on inaction. I think, doing things now to prepare for this is a good idea. Obviously, if the Republicans got full control, maybe the estate tax doesn't exist in 2026. But, you can't really bet on that. And then on the other side, if the Democrats got control of everything, we know what was proposed in 2020 and 2021 in terms of very significant changes to the estate tax that would close a ton of this planning opportunity and a ton of the quote unquote loopholes that allow people to drastically reduce the estate tax that they owe. So, that's kind of what you see on the other side. So obviously I can't predict the election. And if you just kind of bet on inaction, then you just assume it's going to sunset. I think a lot of clients are sort of waiting till November to see what happens. Because, I guess if the Republicans did get full control, you could, maybe, be somewhat comfortable that it's going to be extended or changed. But definitely a difficult thing to work with. And the timing is such an issue in terms of, by the time we're in November, you'll literally have a year to get something done. And a lot of these things take time to implement just because there's complexities with the assets involved. There's decisions to make on how to set up the trusts. And, a lot of that can get bogged down. And so having a lot of lead time to make a major gift is important. And I imagine that estate planning attorneys that do a lot of major gifting, if it looks like it's going to sunset, will be extremely busy in 2025. And so I think at least preparing, thinking about it, what would you do? How would you set it up is a really good idea, just to be prepared, even if you wait till November to kind of see what directions things are going.
Yeah, and I'll certainly add that if you don't have the basic documents in place, regardless of which way this election goes and what ultimately happens with these tax laws, that should go ahead and be taken care of ASAP, because we need to have these basic wills in place, powers of attorneys. I'll say also, if you listen to this presentation and you need to change some provisions in your existing documents, those should go ahead and be taken care of now as well. It's maybe more the advanced tax planning and things of that nature that we might have a little bit of time on, but not a ton of time. We certainly don't want to wait until the very last hour. We had a question come in, John, about going back to revisit silent trusts. Is there an age limit for a silent trust for children? Can you create silent trust for maybe adult children?
Yeah, that's a great question. And I should have mentioned when I said it, that it really depends on state law and how flexible state law is on how trust can be created and those types of provisions. I believe some states wouldn't even let you do a silent trust at all, that there'd have to be some kind of reporting to beneficiaries. In the state of Tennessee, we have an extremely flexible law that basically would allow you to make a silent trust for anybody of any age. They, as a technical matter, might not ever know about it, even if they were a discretionary beneficiary. And that's just kind of the nature of a state like Tennessee having very flexible trust laws. So no limit as long as you can find the right state to create that trust in.
Is it possible to be a resident of another state but still somehow use Tennessee trust laws and trust structures?
It is. Typically it involve having at least, if there are multiple trustees, at least one trustee being a Tennessee trust company or Tennessee resident individual. But definitely, clients from out of state can create Tennessee trusts, and Tennessee's not the only state that has those types of laws. It's very, state specific.
Yeah, I will say their state law rankings that come out, and the state of Tennessee seems to consistently be ranked in the top 5 or 10 in terms of trust friendly states. So it is a state worth considering in terms of your strategy. We're already hitting on a question that was submitted as well, which is, we touched on this. How important is it to factor in your state's specific laws and even your state's state gift or an inheritance tax when it comes to also planning from the federal tax level?
Yeah, it's definitely very important. Most states that do have an estate and gift tax or inheritance tax, the thresholds are lower, much lower typically than the federal one. So Tennessee used to have one. We don't anymore. So we don't have to do specific plans to capture the state and federal benefits. But if you're in a state that does have an estate or gift tax or inheritance tax, it's definitely something to, get state specific advice on, because those things can be complicated in how they interact with the federal tax as well.
Okay. And if somebody submitted a question that, let's say that their estate plan was created 10 years ago, and they generally feel pretty good with it. They feel pretty good with the people that are named, the provisions that are in there. Is there any reason to update it just because it's old?
I'd say not necessarily. Drew, I think reviewing it with somebody who has, kind of a little more knowledge about it maybe would be advisable. It's not always the case that it needs to be changed. I would say, major changes in the nature of assets, net worth, because a plan for somebody who might be taxable is going to look a lot different than somebody who's not going to be taxable in terms of the estate tax. Changes in family situation, obviously. You had young kids when you created it. Now they're older, and now you can make decisions on when they get things or when they take control. And then changing, if you move states, I would say it's almost always advisable, not completely necessary, but to at least have somebody in the new state look at those documents and let you know what kind of changes would be needed just to adapt to the new state's laws, because all states have different trust laws, different estate laws, different power of attorney laws, and it's just typically there is some state specific variation that should be addressed when you change states.
Okay. We have, I might try to get to 2 more kind of quick ones here. One of them being, if your balance sheet is set up in a way where you have named beneficiaries on financial accounts, transfer on death, payable on death instructions, you figured out something with your house. In order to do that, do you still need a will if you feel like most of your assets you've kind of left instructions or planned for?
It's a great point, because a lot of people have a lot of their assets like that, and maybe especially on the first death, there's really not much that goes through probate or through the will at all, because there's beneficiary designations and joint ownership and all those kinds of things. So I would say it's advisable to have a will regardless. I think that one, naming the executor who would be responsible for, there can be unknown assets. There can be situations where there's a lawsuit, wrongful death kind of thing. The executor would often control that. So there's circumstances where even if you thought you had everything named, there's going to be something for the executor to do. And otherwise you'd be doing, estate administration that, as we mentioned, is just more time consuming and costly. And then the other one would be, if you have minor children, you have to name a guardian, or else, somebody else is making that decision for you, who takes care of your minor children after your death. So that's by itself is a big reason to have a will, especially for people with young children.
Okay. Well, that's all the time we have today to get through the questions that were submitted. Thank you for joining us. Thank you, John, for being here and being subject matter expert and talking us through this. So just to recap, it is a very important and timely time to be looking at your estate plan. It's a timely time to be updating it and considering the changes that are coming if that applies to you, to be sure that your basic documents are in place with the right people, and also thinking about potentially more advanced strategies like some tax planning, some closely held business planning, things of that nature. So if we can help you in any way, please don't hesitate to reach out. You'll receive a message after this presentation with some further contact information. But John and I would both love to speak with you and talk through to see if we could help in any way. So take care, and thank you for joining us.
Thank you.